All right, so welcome in everyone. Today is day 12 of the boot camp and of the mentorship, if you want to call it. Today's class is going to be my infamous shorting masterclass. I think I've streamed this. This is probably going to be my close to my 10th time streaming this. Um, Sometimes throughout different educational programs that I've worked with in the past and through different groups and all that. So if you guys have watched this in the past, I do still suggest that you stay in and watch it because it is slightly tweaked and slightly refined. But regardless, I needed to include this and because I really believe in studying the same concepts time and time again and really making sure that you have it drilled into your head, right? Going over the same, whether it's a book that you're reading, whether it's a video, whether it's a article that you're reading, you got to go over it time and time again to make sure that everything is actually sticking with you. So let's go ahead and dive right into it. Before I get started, I'm sure that most of you are not that familiar with going short. I don't blame you. The markets do tend to go up. The long side is easier, and the short side feels very tricky at times. I completely get that, right? Let me just put that out there. I understand that and I understand why you would feel that way. However, I will say that adding the skill of shorting consistently into your trading arsenal will most definitely be a benefit, especially when it comes to a market condition that is very shaky, whether it be a bear market or whether it be a range market. Knowing how to trade the downside will certainly put you in a much better spot than not knowing how to trade them. Another thing is that you can also use some of these tools in order to hedge some of your long-term investments, right? Like for example, let's just say you have Tesla commons from the, let's just say, $200 level, right? And it's in your long-term portfolio and you don't plan on selling anytime soon, but you know that Tesla is potentially setting up in a distribution, right? And you know that Tesla is likely going to pull back, let's just say 20-25% off the highs. But you don't want to sell your Tesla stock because you still think it looks good, you still believe in the company, you still believe in its fundamentals, and you think it's going much higher over the next 5 to 10 years, let's just say. One thing that you could do to protect that, right, and to hedge against it is to actually trade the downside via puts when the chart tells you to, of course, right? That could be something that is very beneficial and something that you should have an open mind to. I'm not telling you go ahead and start shorting from tomorrow, but I'm just saying be open to it, right? So it has its benefits, not just its profit, the benefits of profiting during a bear market or a market that's in a range, but also to hedge some of your long-term investments effectively, right? You don't want to be a guy that's just buying random shorts just because you want to hedge your long-term portfolio. No, I don't think that's smart to do. But when you have the tools to actually understand when something is setting up in a distribution and potentially gonna pull back a couple of 10-20% of the highs, then by all means going and trading the downside will definitely be beneficial. Now personally, I only trade the downside via long puts. I don't like shorting shares, although sometimes it could work, especially on a high beta name. Something like quantum names where the IV is extremely high and the name already moves quite a lot intraday. Shorting shares then or commons could potentially work, but me personally, I'm more interested in just longing puts. So just putting that out there, and I think it's just a much better way of going about things. So let's go ahead and dive into the content. So the roadmap, I'm talking about institutional distribution, sweeps and failed breakouts, how to know when a markdown is potentially starting, and the confirmation of that, right? As we mentioned, exiting stage 3 into a stage 4. That's exactly what a markdown trigger is. The entry playbook, what I look for to actually enter on names that I think are going to move to the downside and how I successfully short them. My exits, some targets and rules that I use when it comes to exiting out of my short. And then I also have a small A plus checklist that you could use, as well as the timeframes that I use. And then I'm also going to be including my little bonus at the end, which is kind of a speculative idea, I guess you may call it. But without a doubt, it definitely is something that works. Not all the time, but it does work. All right, so distribution, right? And just as we've talked about it in the past, it comes after a large markup, right? After a big uptrend. You don't want to be a guy that's looking for distribution after a name has popped or had a short-term rally. That is not something that I would more so call distribution. Instead, that could potentially just be a rally that could be shorted and something that is already downtrending. That's something that's different, right? When we talk about distribution, we need to see a base, right? We need to see a range. A range is when price enters between two levels, a certain resistance spot and a certain support spot, or a certain supply zone, and a certain demand zone, right? And it just consolidates in between those two levels, with the pops getting faded and the dips getting bought and price not really moving anywhere, right? You need to see that for you to be able to confidently say that something is in distribution. No base and no range, no distribution, right? Just put that in your head. It could potentially set up for a mean reversion or a parabolic short, right? Which are two valid short opportunities. However, that name without a base is not in a distribution, right? So make sure you have that down and you understand the difference between a distribution and a mean reversion, right? Like, for example, I don't think silver is in distribution, right? How would I say that silver is in distribution? I can't. I can say that it could potentially be a valid short on a parabolic blow off top, right? Which could potentially mark the start of a distribution in the near future. However, as of right now, I cannot claim that it is in distribution. What can I claim is potential distribution? QQQ right now, Nvidia. What else is there? Any tech name that comes into your mind, Tesla, Palantir, yes, of course. Any tech name, or not even just tech name, any name that is in some sort of base. You need that base. No base, no distribution, right? Always write that down. Doesn't mean the short is not valid, but it just means that it is not in distribution. And one thing to note, mean reversions and parabolic shorts are great setups, which we will be breaking down next week, I believe. However, keep in mind, they do not even come close to shorts that are valid in distributions, right? I just want you to keep that in mind, that names that have a base and names that have set up in distributions, right, and have a range to trade off of are, I don't even know how to say it, 1,000,000 times better than shorting something on a parabolic short or on a mean reversion. Even though a parabolic short might look extremely attractive and could potentially lead to some big leveraged wins, distributions are still a much better trade because of many reasons. We'll be getting into those. So it comes after a markup, right? Large players begin to sell into strength and you start to see price consolidating within the range. Price stalls near the highs and builds a defined range. Progress begins to slow, right? You're not really seeing that clear trend up. You're not really seeing the clear higher highs and higher lows. A higher high could be made, right? I'm not saying it can't be. A higher high could be made and then it ends up getting faded and fails, right, with an upper wick. Or progress, right, with price not really moving anywhere, right? So no true follow through. Even though a high can be made, that high will usually get sold. Distribution often precedes a breakdown, right, where price breaks down from a range and enters into a mark down, which is a downtrend, which is also a stage 4. And that is when the true milk part of the trade is, right? That's where you get to really juice it and pull out as much profits as possible from there, right? So you always want to wait as long as possible and wait for the stock to get as ready as possible to actually get short when it's entering a stage 4. Within its stage 3, some trade opportunities could be valid and could be setting up. However, the best trade will come when price actually enters into the stage 4 and into the downtrend. So how can one spot the distribution range? Spotting the distribution range is not very difficult to do. Here I have on the right a picture of QCOM from the summer of 2024 that offered a very, very textbook distribution. This is on the weekly time frame, and you can see how it led to a big markdown, and it actually offered quite a few very easy readable setups, and it was just an overall very, very clean read that you could spot from a mile away if you were trading it back then. Funny enough, I was actually long into the distribution, and then I flipped short and I capitalized on a piece of this move. Not the whole piece, but not the whole thing, but I did get a piece into the markdown, which is usually how you want to be trading, right? Being long an aim in a stage 2, getting out of it when it enters into the stage 3, and then when the stage 3 finalizes and potentially enters into a stage 4, you look to flip short and potentially roll your profits from the long, which is what I did here, right? The money that I made on the long side, right, gave me a nice cushion to trade with. And then as I spotted the stage 3 and as we began to break down out of the stage 3, I capitalized on that and rolled my profits that had a very nice cushion to them, and the trade was essentially very stress-free, right? Because I knew I had profits to risk. Right, so step 1 is map out the actual range, right? Map out the highs and the lows that are getting bought. I suggest using zones instead of levels, at least for now, until you get some consistency. And then you could look to use levels. I just don't like, usually when people, even I sometimes, when you use levels, you expect that price is going to move from level to level and respect it to the penny. Right, as in price is going to bounce off of this exact level and reject at this exact level. It is not allowed to move over unless I'm invalidated. And the truth is, that's not true. Stocks are not perfect, right? There's a million variables that go into play when stocks actually move. And it takes a lot more than just a simple line for a price to actually respect for a setup to be validated, right? A setup can instead bounce around a specific supply zone or a specific demand zone, and then you can look to execute off of that. I personally do still draw levels. I don't really draw zones that much, but I also know in the back of my head that this is not the exact level that I need to execute off of. I will allow price to have some breathing room around that level and potentially fluctuate slightly above it or below it, and then the trade is still valid, right? It's not invalid because I got a 1 point tick above the level. Volume, right? We know that we need to see volume heavier on the down days and lighter on the up days. As simple as it gets. You want to see volume coming in at the highs, right? As we mentioned, I hope you guys are really tying everything together by now. You want to see volume coming in off the highs, right? With high volume that leads to weak closes on the bars, right? Near low of day with large upper wicks, and bearish bars that engulf the previous bullish candles. If you backtest yourself, right, and you go and study any distribution range, you'll always notice that the best trade opportunities within a distribution range will come after a bearish engulfing comes, which will usually happen whenever we have some sort of headline, we have some sort of catalyst that gaps price slightly higher, and then price fades that and closes below the previous day's low, right? And that leads to a big bearish engulfing on higher volume. Perfect example of that is the Nvidia DeepSeek short. The day before the DeepSeek short, we got exactly that. Price was gapping up. We got a bearish engulfing on a slightly higher volume day, and then the next day we got that massive sell. A lot of people will say it's luck. Not really. There's a lot of things that go on in a chart that allow for such a big move to happen, right? Which we'll be getting into next week. Bearish expansion bars, right, dominate near the highs with just simple, right? Keep it simple. More bearish price action than bullish, right? You're not seeing bullish engulfings. You're not seeing dips getting bought up. You're not seeing sweeps of levels from the downside, right? You're not seeing any buyers stepping in off the lows, right? Instead, it's all the action, all the volume is coming in off the highs, and then that tells you that institutions are dumping things on highs, right? Keep in mind, just because price makes a higher high, that doesn't mean the setup is invalidated. It might mean that the current attempt is invalid and you need to cut it so that price doesn't enter an uptrend above you. However, you want to look out for these highs to actually get sold, which is what a sweep usually looks like, right? Highs that get swept and price can't really hold above, right? You have this image here on the right, which represents exactly that. Can I zoom in here? Should be easy for you guys to read, right? You see the side. This is on the weekly time frame, by the way. So pairing this weekly time frame with the daily would have been just absolutely beautiful. And just, man, this chart is just amazing. But yeah, that's exactly what I'm talking about, right? You get that high that got swept, and then from there you get that mark down. You see that extremely high volume, the highest volume, right? Throughout this entire run up, where did it come? Off the highs. That should really raise your eyebrows, and you should start to think, okay, this is very fishy, right? Something's going on here. Institutions are likely dumping this off the highs, which is exactly how they make money, right? They sell into these highs and buy in off the lows, right? They're not gonna go long up here at 230. So you got that range, right? You got that sweep, and then from there, price enters a mini consolidation phase, but looks kind of similar to a bear flag, right? As we mentioned yesterday, you want to wait for that momentum setup to be present, and you want to wait for these resting bars to appear, and that's what we got here. You see that extremely low volume, right, on these two slightly higher candles, and then the third week, big rejection out of where? Out of a bear gap, which we will be discussing. By the way, gaps are a very big aspect of my trading, and the more I mature and the more I excel as a trader, the more I realize their importance, and the more that I actually use them. But we'll be covering that as well. So we get a lower high out of there, and then price sells off from 210 all the way down into the 150 spot in the matter of 3 trading bars or 3 weeks. And then price finds some sort of bottom and consolidates from there. Textbook chart that I studied for quite some time. And this was during the time where I really became, I don't want to say a master of distributions, but where I became extremely good at them and extremely good at spotting them well before everyone else does. And the reason I'm able to do that is because I got burnt many times chasing the highs and buying breakouts near the highs when names were clearly in distribution. And through those experiences and through those losses, I was able to sit down, journal, review, reevaluate, and then come to the conclusion that, okay, no, these names are in distribution because of X, Y, and Z. So that the next time this happens, I'm able to spot it. That time frame, right, summer of 2024 had a lot of these charts, especially on semiconductors. You can go back and check out NVIDIA. You can go back and check out SMH. Those are two great examples that also set up very nice, although slightly smaller distribution zones. There were still distributions nonetheless. And they ended up playing out very nicely into a very kind of a flash crash into the August 5th low, which was a Black Monday, which was very tough for a lot of traders that didn't really see that coming. But for the ones that were able to think logically and able to zoom out and actually read the range, right, and not just blindly chase into the highs, they're able to spot that coming from miles away. So liquidity sweeps and failed breakouts, this is a very key part of my reads on distribution. All the best distributions are always going to have a failed breakout, right? All of them. If a name does not have a failed breakout, it could still be in distribution, obviously, right? But it is nowhere near as good as a name that does have a failed breakout. Now, a failed breakout doesn't necessarily mean a multi-day move over the range, although that would be the best because that lures in the most retail, right? That matches the institutional selling, and then they dump out of their shares at the highs for that quote-unquote all-time high breakout. But even if price just kind of pops above it for a few bars and then comes back down, that still remains a failed breakout. However, the best failed breakouts, write this down somewhere, come with catalysts. Could be a certain economic data, right? Like CPI or some sort of FOMC or some just any data that comes in that gaps a lot of names higher. But the one that's even stronger than that is the one that is an individual based catalyst, right? An individual name based catalyst, like a catalyst that is specific to a name. Great example of that is the NVIDIA AI event last January 7th of 2025. Price gapped up 3 days into that, and that gave us a massive, massive failed breakout that led to price selling from the high to the low of about 8%. And that marked the top for quite some time until NVIDIA entered continuous distribution into DeepSeek and then into a big sell-off. All right, so that's January of 2025. That was textbook, right? Another one is this chart that I have here on the right hand side, and this is the SMCI chart, which was another absolutely textbook one. This was pre-split. If you guys go back and take a look at this, sold off way lower than just into the 500 spot, way more than 50% off the highs. Funny enough, guess what was happening to SMCI back here? I don't know if you guys were trading back then, but I just want you guys to take a wild guess as to what was the catalyst that pushed price up, and what was the catalyst that topped price? Nasdaq. Exactly. How funny is that? That the day that SMCI gets listed on the Nasdaq or announced that it's going to get listed, I don't know if it was the actual listing or the announcement of the inclusion, one or the other, is the exact week that SMCI tops forever. I mean, at least until now, right? How funny is that? And you want to know what's even crazier? After this entire markdown, after this entire downtrend, SMCI got delisted from the Nasdaq. And guess what happened then? Price bottomed. Can you guys just sit and think about that for a second? How crazy is that? Yeah, people tell me I'm crazy when I talk about how good headlines are often great shorts and bad headlines are often great longs in basis. Right? Just sit and think about that. The Nasdaq inclusion is the catalyst that tops price, and then the Nasdaq, what is it called? Getting delisted from the Nasdaq is what bottoms price. Right? It's just absolutely crazy stuff to think about. And you'll see it happen time and time again, right? Now, obviously, that doesn't mean go ahead and short any good headline that you see. Of course not. You're going to get absolutely squeezed doing that. Instead, right, it's the same thing that happened here on SMCI. You see this big gap up, that's when the inclusion was announced. The initial short sellers, right, the ones that tried being the smartest and tried being first, got squeezed out the next couple of days. Right? But the ones that were patient and waited for exhaustion above that headline, above that catalyst, are the ones that eventually got paid and got paid fat. Right? Which is another topic that we will be discussing, and how to successfully go short, right? Even on good headlines by waiting for the exhaustion above the highs and then looking to fade that by slowly bidding into puts on pops that have failed. That is a very, very big part of my trading, and a part that I experienced myself and kind of built out an execution system that I follow. And it works like an absolute killer. And it's how I'm able to get extremely good entries with very, very high probabilities and great risk management. But that's going to be in the more advanced class when we actually begin to talk about the lower time frame execution. But yeah, for now, just look at this chart, right? And look at the big failed breakout that we got above the initial high that happened. Another chart to study alongside the SMCI one that looks very similar is the MSTR top, and I want to say, was it November 2024? I might be slightly off. I think it was November 14th. No, November 21. Okay, I was close enough. Of 2024. Similar chart, but this one did not have a failed breakout above the liquidation high. But still, nonetheless, a very similar chart that you can study. But yeah, so failed breakouts, right? Very, very important to our distribution reads. And this not a criteria that is a must, but it certainly makes a setup way better. Like it takes a distribution chart from a C tier, right? Like let's just say distribution without a failed breakout is a C tier short. After the failed breakout and after the exhaustion of the highs, that moves up to being an S tier short. So keep that in mind, right? So you want to look for a pop above the range, right? Which will get that FOMO, right? From the breakout buyers and a lot of retail. You're also going to be seeing a lot of headlines about X stock making new all-time highs and everyone just being all over a certain name, right? While in reality, what's happening is institutions are just using that as liquidity, right? And then it's very, very important that you also wait for confirmation, right? Which is simply a close back inside the range, right? Or below the breakout spot. This is very, very important, especially when swing trading, right? You don't want to be someone that is buying puts and buying shorts at all-time highs blindly. That is a recipe for disaster, and that is exactly how you can blow your account, right? Do not do that. I've blown my account many times doing that in the past, right? Don't be that guy that's trying to time the exact top. Instead, you can either slightly start to position extremely light at the highs, right, as you slowly bid into puts on new highs that failed, which I will be diving into on how to do that. Or you wait for the confirmation back below the range and then you risk that failed breakout high. Because if that holds, right, and you see some lower high action that is next to the failed breakout, then you have your confirmation, you have your risk to reward. Right, from there it's lower high and support loss, right, which sets up for a very, very good and powerful markdown that would usually mark the start of a stage 3. The failed breakout will usually come close to the start of a stage 4. The failed breakout will usually come as a distribution is near the finalizing stage. Not always, but from the charts that I've studied, more often than not, the failed breakout is usually close to the stage 3 ending and a stage 4 beginning. However, it depends also on the size of the distribution, right? Because distributions can happen on all time frames. We're focused mainly on the daily. So sometimes a distribution could take months, right? Like think of NVIDIA right now. NVIDIA has been in distribution since July 31st, since the day that quarter 2? The quarter 2 earnings for Meta and Microsoft after the FOMC on a Wednesday that topped NVIDIA. From then until now, price has gone nowhere, and I believe without a doubt it is in distribution and it is setting up for lower. However, right, if I just blindly bought puts back then, right, that were expiring in, let's just say, a year, and I just held them, I would have gone squeezed. Not because price went against me, but because price didn't go anywhere. Right, price didn't go anywhere. It did sell for a bit, and then it got bought back up, and then it got sold, and then we got hit with OpenAI, and then we went for the 200 overshoot. Right, so things weren't ready yet to sell off, right? You can't just expect a name to go on a massive run for 7 weeks and then top out in 3 days, right? No, it's gonna take a long time. So always keep that in mind, right? So after the failed breakout, look for some sort of lower high action, right? An action that confirms price failing back under the range, right? Back under the previous resistance that you're looking at, and some confirmation below that. From there, you can just risk that high. Right, now keep in mind, guys, when I say risk that high or take this trade, I don't mean, okay, I'm gonna take this exact option and I'm gonna risk that exact daily high, and if price moves above that high, I'm out and the setup is done. No. What I mean is I'm gonna look to attempt said setup within that lower high zone, and I'm gonna be using the failed breakout high as my risk for me taking the idea off my watch list, right? My exact risk on that option is not going to be that high, because that high, right, the failed breakout high, is likely going to be, let's just say, 5, maybe 10% above me. And if I wait that long, I'm obviously going to get destroyed, right? I'm not going to hold on to a put while price moves against me 5% or 10%. Right? My puts are going to be destroyed. I'm going to be down 30, 40, 50%. Right? No, I'm going to execute differently, but the idea remains valid as long as that failed breakout holds. Right? An idea remaining valid and a trade attempt remaining valid are two very different things. Right? Keep that in mind, especially as options traders. As a commons trader, you can go ahead and do that by all means. Right? Don't listen to anyone else that tells you you can become very successful at trading options by just attempting a certain stock once. I know it's not how it works. You need to be able to look for different ways to maneuver around price action in order to capitalize the best, which will force you to size down, right? And take lighter size until you get true proper confirmation. Then you can size up as your position is in profit. Guys, these are some of the basics that have kept me alive to today. And these are some of the basics that I developed in my system years ago, and I will never, ever move away from them. The day that I move away from them is the day that I begin to lose money, right? Stick to the basics that I talk about, just like only adding as confirmations in your favor, adding into a winning position, never being short above the opening print, never swinging a red position, always buying enough time, right? All these basic stuff is what's going to keep you in the game long enough. This is where longevity comes from. Longevity doesn't come from big wins. Longevity doesn't come from flashy leveraged plays. Longevity doesn't come from ZDTs. No, longevity comes from the basics. You can easily catch massive wins. You can easily catch flashy wins and home runs, right? Anyone can do that. But what's actually going to keep you in the game long enough, and when I mean long enough, I'm not talking about a year. I'm not talking about 5. I'm talking about 10, 20, 30, 40 years, right? Talking about doing this for a lifetime. It's these basics that we stick to. Okay, back to the presentation. So the markdown trigger, right? Or the trigger of when price exits a stage 3 and enters a stage 4. This is the most important part of a distribution, right? And where your eyes need to be when you're looking to trade the downside, because this is where the biggest amount of profit lies. The markdown trigger is when you get a decisive daily close below the range low. When you get that daily close below support, that is your confirmation. That doesn't mean go ahead and buy puts, by the way. No, don't do that, because you're likely buying puts on a 3-day action that price may be sold 7-8%. Don't do that, right? You're going to be buying the low, and price is then going to consolidate. You're going to get fried. Don't do that. But that is a confirmation of the idea being present, right? Notice how I'm talking differently when it comes to talking about a certain trade and talk about an idea, because they're two different things, right? You need to differentiate the both. So the trigger is a decisive close below the range low or below the support, right? And you get that break. From there, you want to see multiple daily closes below the base. That just shows that price is accepting this new level, right? And it's basically your confirmation that price is actually breaking down. Right? You also want to see volume starting to come in, right? And you want to make sure that that support isn't swept, because if support is swept and you see that high volume, then it is likely buyers that swept that low and they want to send things back up. Maybe they'll go for the breakout. Maybe they'll go for a new failed breakout, right? And squeeze price back up to the highs. A good example of that is NVIDIA before the 200 overshoot. I was short back then after October 10th on the China news. We got a couple of days consolidation from there, and then price looked extremely good to crack and enter into a stage 4. But what happened instead is support got swept. And then fast forward 3 days later, and we go from, I think it was maybe 180 to 210 in the span of like a few days, right? If you guys remember that euphoric move on NVIDIA, that was just insane, right? And what marked the start of that was the sweep of support. So you want to make sure that you are getting that daily close and that price is actually staying under the support level and under the range low. Right? The second you see that sweep, just cut it, look for a re-entry. Don't stay in that with the candle sweeping. You're most likely gonna end up getting squeezed out the next day. Instead, you want to see bearish engulfings as price breaks down from the support. And usually price will be below declining daily moving averages. Right. As you guys know, I'm not the biggest fan of moving averages. However, they are a part of my trading. And that part is very, very important when price is in a trend. Right? I don't care about it when we're in the middle of distribution range, right? Like, for example, just take a look at this chart. This is the same chart, by the way. QCOM. Remember this chart here? This weekly. This is the daily of it. So you can see how everything played out beautifully. Throughout this range, right, the daily moving average didn't really mean anything. Here they were kind of acting as support, tried acting as resistance, but nothing. Hold on, my screen just froze. Okay, we're back. Hope you guys can still see my screen, right? Okay. Yeah, so the daily moving average didn't really mean much. But now as we begin to enter stage 4, now you can see that they are being respected very nicely. Right? So this is when I started to pay attention to my daily moving averages, and I really give them a lot of weight, and I make sure that my short entries are as close to the daily moving averages as possible. Right? Because if they're far away from the daily moving averages, that means that price is slightly extended. And I don't want to be going short when price is extended. I want to wait for price to come close to the moving averages, and then I will look to go short from there. Right? I'm not going to look to go short when price is extended, right? It's like, I'm not going to buy a short down here. No, it's clearly far away from the daily moving averages. But up here, look at that. As well as the retest of the breakdown. Perfect. Big leg down, slight pop, leg down. This is a weird pop, but then another leg down. So I want to make sure that price is below the daily moving averages, right? And I'm looking to get my entries close to that. So an entry playbook to use to get some high probability shorts on the daily time frame, right? This is my entry playbook. This is not my execution playbook. Those are two different things. My entry playbook is what I look for on the daily time frame to know that the stock is ready to be shorted. However, that doesn't mean I should execute it on the lower time frames. Right? Again, two different things. Right now we're starting to take it up a notch, and we're talking about a bit more in-depth analysis on how to actually take your game to the next level, right? So please be paying attention. Don't get lost. The entry playbook is what I look for to know that a stock is ready on the daily time frame. But that doesn't mean it's ready to be executed. The execution comes on the lower time frame intraday session analysis and how I actually buy into options. Because keep in mind, options are not stock, right? There's tricks around trading options, right, that you could use to your advantage, right? To make sure they don't get crushed, to make sure that you actually get a good entry, to make sure that you're not buying into a spready contract, so on and so forth, and a lot more than that, which we will be diving into next week. But for the entry playbook, I'm going to look for on the daily time frame to know if it's ready after I've already done the analysis on the overall price structure and the market cycle and seeing the momentum setups being present. Now I'm looking for the entry playbook, which is simply one of a few. Or it could be all of them at once, but as well. Breakdown retest, right? So you see a certain support zone that gets lost, and then price moves back up into that support zone, which is now above us. That acts as resistance, right? Basic support resistance flip. Simple stuff, right? I think this is probably one of the things that you learn in the first ever technical analysis course that you buy, or even if you just search TA from zero. This is it. right? Breakdown retest, right? Support turns into resistance. That's one of them. A moving average retest on the daily time frame, right? Weak bounce or weak pop into the 8 and 21 and the 50, but usually the 50 is still going to be quite of a distance above us, and reject, right? Next, we got inside days. Inside days, I absolutely love. I am in love with inside days. There's nothing that I love more than seeing an inside day print on a name that I'm looking to trade, because inside days do signal compression. Just how a bull flag illustrates compression, an inside day does that too, right? We know that price is compressing in a little inside day inside the bar that is before us, and with compression comes expansion, right? We know this. So when an inside day or a double inside day, even better, are present, now things are looking higher probability and have the potential for more speed out of the setup, which is when I want to be aggressive with options. So inside day / tight base under resistance, right? Which could be the daily moving average, or it could be a previous support zone. It could be also a certain gap, which we'll be diving into as well, right? Then we look for the continuation break from there and a move lower. This here is another distribution markdown chart. This is Google during the same time frame. You can see how we got this weak rally into support, into the daily moving averages. Big sell here. This was kind of a bit tricky, but another one. And then down into this low. Obviously, another very important one is watching for the bearish engulfing after a failed pop, right? That's the trigger. Doesn't necessarily mean go all in on puts, but you want to look out for that. Now, stops, targets, and exits are a part where you kind of have to be a bit more open with. Knowing when a stock is ready to move out of a setup is easy. It's easy to do that. Knowing when the setup is done, right, and the move is done is difficult. That is something that every trader will struggle. And it's not necessarily a struggle, but it is a challenge. A good challenge, but regardless, a challenge that every trader will face, because you truly don't know when a stock is done, right? So this, you kind of have to give it a bit more wiggle room, right, and look out for different things. But here are a few rules that I personally use. Right, a big one. Let's just talk about stops first, right? We move back up above a certain range, right? Like for example, if there's a support, it reclaims it, or we sweep low of then we squeeze out to the other side. We reclaim a daily moving average. We reclaim a bearish engulfing bar. Those are all invalidations, right? And I'm no longer looking to trade this until that fails again. All right, we'll talk more about stops when we actually dive into the execution. Targets, I usually look for prior support zones, right? You could use measured moves as well, although I personally don't really do that anymore. But essentially, right, if a name enters a distribution for a couple of months, then you should expect that the markdown that follows to be large. If a name enters a distribution for a couple of days, then you should expect that the markdown that'll follow will be smaller. All right, so keep that in mind. I like to scale out into support, right, and into previous gaps. I like to use gaps as targets, gaps that were unfilled below us. Those are great targets. Sometimes if we have a previous base that we didn't pull back into yet, that could be another good target. But like I said, at the end of the day, especially when trading things, both to the upside and downside actually, you don't actually know when a name is done breaking out or breaking down, right? As you start to think, okay, this name is extended and you should close out all your puts at a 300% win, the next day you get a 5% gap down and your puts are up a 10x. That has happened to me in the past many times, both to the downside to the upside. So one thing that I'll always do no matter what is I will always hold on to a runner. I usually like to leave a fourth as runners. So if I'm buying 10 contracts, I'm leaving 2 as runners, non-negotiable. If it wasn't for this, I wouldn't have caught NVIDIA DeepSeek. If it wasn't for this, I wouldn't have caught 2 of my gold parabolic tops. If it wasn't for this, I wouldn't have caught, what else is there? I'm sure I can name many others, but my brain is kind of fried. But yeah, I always keep a runner. No matter what. If you're trading 5 contracts, just leave one. Right? No matter what, a runner will always save you. Amazon's another one, yeah. Always, always, always keep a runner. In fact, most of your profits will end up coming from runners. That's just how powerful runners can actually be. You will find yourself in some of the best breakouts and some of the best breakdowns as you advance in your trading career. So you want to make sure that you are leaving a runner that absolutely goes crazy. Right? Sometimes I'll take it to the extreme, which is a bit extreme, and I don't necessarily suggest you do this, but I'll leave my runner until expiry. But that is a very extreme case. That's something that I absolutely love, and I think is just gonna go parabolic. But yeah, runners are left. Right? I don't care if I'm up 500% on my last 2 runners. I'm gonna raise my stop to break even. That's a definite, right? We all know once your position is in profit of above 30-40%, you move your stop to break even. Never let a green trade go red. Only a fool would do that. Don't be a fool. Green trades are either massive wins or break even. They never go red. And I don't mean green by 5%. That would be stupid. I mean green by 20, 30, 40%. Even 20, you can kind of give a bit of wiggle room, but 30 and up, don't let that go red. Never. That is very foolish. So yeah, I'm looking to scale out into support and into previous gaps fill or previous bases that are being retested into. If price reclaims the daily moving averages and holds, right, I'm gonna likely take my loss or just cut my win. Or if I start to see some very, very high volume, right, some very unusual volume pouring in at the lows, that leads to also some sweeps and some very strong bullish engulfings, I'm gonna be out of my position as well. Here I have a short checklist, right? A plus short checklist that you could use. Number 1, distribution range is formed at the top after a big uptrend, right? Sell volume is dominant, right? You see the bearish engulfing bars, bearish price action overall, big liquidity sweeps, upper wicks, right? Failed breakout above the range highs. Now we're beginning to break down, right? With the daily close below the range, so you can actually capitalize on the name entering into a stage 4 from a stage 3. You're getting your retest and rejection of a breakdown spot or a daily moving average. That will be your A plus entry playbook, right? And price is under declining 8 and 21 daily moving averages, so that the trend is aligned. This is the most basic yet most powerful A plus checklist if there was ever one. And I'm speaking this from my personal experience. All my best shorts, as you guys know, I love trading the downside. Probably a bit more than I should, but yeah, I love trading the downside. And all my best shorts ticked off every single box in this. Majority of my shorts that didn't work had 1, 2, or 3 boxes missing. So always make sure that all of these boxes are ticked. That will put you in the highest probability for a very successful trade that hopefully runs multiple 100, 200, 300%. Time frames and avoiding early shorts. One thing that a lot of people struggle with, even I sometimes struggle with, is I'm short slightly too early. I see a read on something, right, and I start to get aggressive on it, not knowing that I'm just a bit too early, and it forces me to take a loss or 2 before the setup actually works. For the time frames, right, you want to use the weekly for the context and looking at some broader key levels, right? Then the daily to actually look at the range, look for the failed breakout and the failure, right? And then look for the breakdown trigger. The hourly is used for levels, right? So you can mark down intraday levels and gaps. And then the 15-minute or the 10-minute, I like the 10-minute, to actually look for the entries. Don't be on the 1 minute, don't be on the 3-minute. Those are for fools. We are not fools. Right, avoid those. Those will just give you a brain, a mind fuck. Excuse my language. But yeah, don't do that. Don't top tick. Don't be the first. The first shorts will always get squeezed more often than not. At least, don't get squeezed. Let the ones that can't sit on their hands get squeezed. We'll buy out their stops, and then we'll be the ones that make the money. And then look to get aggressive after failure is confirmed. Right, don't be afraid to do that. Your position is in profit, you're up 30%. If you want to double down, go ahead, double down, right? Technically, your position will move from 30% to 15%, right? And then put a break-even stop. That's a risk-free position that is probably going to lead you to a massive, massive win if it does work. Right? Don't be afraid to do that. I'm certainly not afraid to get aggressive. when I see what I want to see, when I get the checklist ticked. As a bonus, right, this is my kind of speculative little addition. Upgrades as liquidity events. This is something that I've seen and I've experimented with time and time again. When you see those fishy analyst upgrades, that are you kind of like a bit fishy of like, why are we getting an analyst upgrade at the highs in a very clear distribution chart with no reason, right? It's not like it just came out off of earnings, right? It's not like it just had a massive report that came out about its products. No, it's just very fishy and it's out of nowhere and there's no true reason for it. That pop can be faded many times. I've seen it happen a lot of times. And I've seen it also happen on the flip side. The two examples off the top of my head that I have is NVIDIA topping on one of the distribution bases that is set up on an upgrade. And another one was in an accumulative base of Johnson & Johnson, which was also in 2024 summer, during the same time as some of the charts that I was discussing here. J&J was in a very clear accumulative base and was looking to break out of that accumulative base. And then we got a random downgrade by some sort of firm and out of God knows where that gave us a small gap down that got bought up very nicely and led to it. And then we ripped over the next couple of days. So upgrades can create some sort of pop, right, which can be used as liquidity for big sellers to exit. As we mentioned, big sellers need the counterparty liquidity to execute on their positions. They're not like us. They need the liquidity to match their orders. All right, treat the pop as a last push. Of course, watch for rejection. Don't blindly buy into puts. Please, guys, don't. If you're going to take anything from... I don't want to say that. One of the biggest takeaways that you should take from this is don't just blindly buy puts. Right? I know I've talked a lot about some of these topics about shorting, and it should probably has you a bit excited to trade the downside, but please don't go just blindly buying puts. Puts are not easy, right? But when they do work, they can be very powerful. So please be patient and make sure that you are following a specific playbook that you have built out. Right? So in this case, which is this, again, this is a bonus. We're talking speculation here, right? We're not talking about something that works all the time, right? No, but it's just something to keep an eye out for. Look for this to be some sort of last pop that can potentially be rejected and failed, right? You wait for a weak orb off the open, and then you look to trade some sort of intraday lower high from there and risk the opening print, and then look for the weak close, and then look to swing that, and then you get a multi-day breakdown from there. The exception, though, is don't watch for big upgrades, right? For example, after a strong earnings call. That could signal some real strength and could throw off a lot of distribution charts that could have been in distribution, right? But we just ended up being wrong about them after their earnings call, for example, right? Don't look to fade that. Fade only when you have the structure on your side, right? And you have confirmation, you have the checklist in play, and you're just looking for this liquidity event of a very random upgrade as a rally to short, right, for an entry. That pretty much wraps up today's session. Questions? Thanks, bro. Appreciate that. This is honestly my best work. This shorting masterclass I've really spent a lot of time on, and it really came from a lot of experiences that I've had personally, and a lot of charts that I've studied. We'll also be diving still a lot deeper into this over the next week when we actually dive deeper into distributions, accumulations, and how to execute. And we'll also go over some of my best shorts where I've seen this play out. A few of which recently played out, just like the Bitcoin and Ethereum top that no one saw coming. So do you recommend holding off on shorts aside the laid out plan? Do you mean aside from the checklist or aside from basically this session? Like V reversals. No, look, there are some other good short setups that are out there, just like mean reversion and parabolic shorts. It's just if I had to rate them on a scale from 0 to 10, the 10 out of 10 is going to be a distribution setup that has a markdown trigger. That's going to be a 10 out of 10. A mean reversion is going to be close to like a 6 or a 7, or actually probably a 5 or 6. And then a parabolic short could be a 7 or 8. Those are the only ones that I trade. I don't trade earnings sell offs, although it is, for example, in a distribution, right? Like, for example, the NVIDIA earnings sell off of this past earnings call, that was a big trade for me that I went short on. But that name was already in distribution, right? So I was just using the earnings as a catalyst to trigger the sell off. Yeah, the charts that you could learn from, I'll send you a few right now, actually. Let me go ahead and type them out. I'll save some of the best ones for next week, but these are some that you could look out for. So you got SMH, summer of 2024. You got MSTR, November 2024. You got SMCI, and spring of 2024. You got QCOM, summer 2024, and you also got NVIDIA of Jan 2025. These are some of my favorite ones. There's also a few more, but these should be enough for now. So the safest ones aside, these are sell the rip in a range probably. Yeah, that one could also be safe, but it's just the thing is, look, these are good shorts, right? All the ones that you just mentioned. However, the ones that can actually lead to a multi-day breakdown are going to be the ones that are already in a distribution, have that markdown trigger, right? And if I had to kind of put it on a scale of which setups are the most powerful, when they are right, when you are correct about things, it has to be breakdowns or breakouts because those ones actually juice your premium. The issue is that most people just automatically go and look to long or short any breakout/breakdown, which is not the case, right? But when you look to trade that and something that's in a distribution, that's when everything aligns to a big multi-day swing, right? Which is what we as swing traders want to look out for. Shorting a earnings sell-off or a reversal or a mean reversion or selling the rip in a range, those are all good shorts. Are they amazing? No, because that dip that comes from them will likely get bought. The dip that is going to be very hard to be bought is the one that is entering a stage 4 from a stage 3 on a very clear distribution that is actually set up with the markdown trigger. Do you see what I'm saying? Yeah. That is the I don't go short on low of day breakdowns. Hmm. Yeah, reversals can work. I personally just I don't like trading so-called reversals. Intraday, yes, I do, but on a broader level kind of perspective, they're not my favorite. But yeah, let me go ahead and end the stream here.